All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. Today's video is titled, Don't Make This Interest Rate Arbitrage Mistake. And that's because newbie policy owners and agents for that matter tend to get really excited when they find out that the cash value of an indexed universal life, an IUL, can generally earn a higher rate of return than the loan interest rate. So they start getting all kinds of crazy ideas about what they can do with that. So in this video, I'm going to show you a couple mistakes that people make and show you a better way that you can go about doing this. So stick around after the intro and we'll get started. Hi, I'm tomrutkowski, president of Innovative Retirement Strategies, and the purpose of this channel is to show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. And I discovered the concept of the double play many years ago on my own, and the concept is so powerful that I really wanted to create this channel to show everybody how they can utilize the power of a maximum overfunded life insurance policy. This video is geared towards those people who are researching the subject and want to have information and have a lot of questions that they want answered, and they want to get straight scoop. So this channel is all about debunking the myths and misconceptions about life insurance and showing you the straight scoop on how life insurance works, trying to separate the fact from the BS. The goal of this presentation is to show you that the proper arbitrage that you're looking for is the arbitrage on the outside of the policy. It's what you're doing with the leveraged cash value. It's not about what the cash value itself is doing. As long as you have money that you can borrow against and put that money to work in some other investment and create value outside the policy, that's the arbitrage that you're after. Not the arbitrage created between the interest rate that you can earn on your cash value and the policy loan interest rate. So let's get started. So the first thing that I want to do is start off by just explaining what the interest rate arbitrage is. Then I want to explain what the interest rate arbitrage is that you should be looking for. And then finally, I'm going to show you a couple of mistakes that people make when it comes to interest rate arbitrage, and then show you a better way that you can do it. So let me start off by explaining what is interest rate arbitrage. Interest rate arbitrage is pretty simple. If you could get money at 4% and you knew that you could safely invest it and earn 6%, how much would you want? The answer is all of it, right? You want to get as much money that you could get or borrow at 4% to turn around and invest it. So you could get an infinite amount of money at 4%. You can invest that infinite amount and create an infinite amount of money. So it's all about profiting on what you're borrowing by putting it to work in an investment outside of the life insurance policy. So where should you look for interest rate arbitrage? As I stated in the intro, you're looking for interest rate arbitrage on the outside of the life insurance policy, not on the inside. People get all excited because IULs historically have earned about 6% returns year over year on the cash value portion. Meanwhile, interest rates typically tend to be about 2% less than whatever the prevailing rate is on the indexed universal life. So they get all excited when they see that spread. But what I want you to focus on is no matter what the growth rate is on your cash value, you have a line of credit secured by that cash value. So you're borrowing that money and investing it on the outside. So again, simple numbers. If you could put your money into an asset growing at, say, 6%, for example, and you could borrow against that money at 4% to invest in real estate making 10%, you're essentially creating a 6% arbitrage outside the policy. That income would be taxable, so that would be reduced by the tax rate that you pay. But whatever you create outside the policy is in addition to the cash value inside the policy. So what is the mistake that people make? Well, when people think that the cash value earns zero in any given year, because with an indexed universal life, you have a floor, which is typically zero. You have a cap, which might be anywhere from 8 up to 12% or more. But in years where the market index that the IUL is tracking goes down, the IUL earns zero. And people tend to think that if they're earning zero on their cash, yet they're paying 4% on the loan, that they're going backwards. But that's not the right way to look at it. Even if the cash value is only growing at zero in 1 year, that 4% money is still being put to work in some other investment. So you're still creating value outside of the life insurance policy. And then it's important to understand that the index returns are going to vary by year. So years of down markets might be followed by years of very high growth in the markets. So it all averages out. All right, so here's the double play formula. The double play is basically two components, hence the double. You've got the cash value plus the wealth that you're creating outside the life insurance policy. And here you can see that it's the investment returns you have outside the policy, less any interest that you're paying on the loan to borrow that money that you're using to invest. And that wealth that you're creating or income that you're generating is taxable, so it's reduced by the taxes. But ultimately, you have a net return from outside the policy combined with the growth on the cash value from inside the policy. So let's look at some sample numbers that might help you understand this. In this slide, we're looking at the impact of 0% crediting on the double play. So I'm basically showing you two scenarios, and I'm showing you beginning of year one as well as year two. But really, I want to show you that in the first year, assuming the premium were $100,000, we know from my other videos that if a policy is properly designed, you should have about 85 cents of cash value for every dollar of premium. So we're showing a cash value at $85,000. And mind you, while these are fairly large numbers, everything in life insurance is scalable. So you can add a zero, you can take a zero off, you can divide it by 2, or you can multiply it by 2. But the ratio of cash value to premium is usually that 85%, give or take. Now, I just want to show you the impact of one version where the policy is credited with a 5% dividend versus the other where it doesn't earn any interest credits in that year. So as we begin year two, now we've got two different clients, one with $90,000 of cash value that they can leverage, and the other with $85,000 of cash value that they can leverage. And if we look on the left at the client that had $90,000 of cash value that they can leverage, assuming that they could invest that money and earn a 10% return, they would have gross income of $9,010. After paying the bank back for the interest on the loan, they would have $4,505 of taxable income. And at the 40% tax bracket, they're going to write a check to the IRS for $1,802, leaving them with a net profit outside the policy of $2,703. Now, if we go back to the other scenario, the other policy owner where in year one he did not earn any interest crediting, he's got $85,000 of cash value, giving him the ability to take an $85,000 line of credit. Same example with the returns, 10%. So in this case, it's a gross income of $8,500. And after paying the bank back for interest at 5%, he's left with taxable income of $4,250. In the 40% tax bracket, he's writing a check to the IRS for $1,700, leaving him a net profit of $2,550. And if we compare that to the $2,703 from the other scenario, you can tell that the difference is only $153. So at this point, I know what you're going to say, that, okay, Tom, I get that did not create much more, but what about the dividend? What about the interest crediting? You know, one had 5,100 and one had 0. So that's a big difference. Well, what I want you to understand is that you need to think of the cash value as your retirement savings. And just like your traditional retirement savings, whether it's in a 401k, an IRA, a typical brokerage account, you're setting that money aside and you're basically forgetting about it for 20, 30, 40 years because you can't touch it oftentimes because of their qualified accounts and there are penalties. Well, here it's the same basic thing. The cash value of a life insurance policy never really leaves. And if the goal is to use it to create tax-free retirement income at some point in the future, then it really doesn't matter what it makes on a year-by-year basis. It could be 0 one year, 12 the next year. But what we're looking at is what is the annualized return going to be over some long period of time. And just like the stock market, people put money in the stock market hoping to get or realize the expected return of about 9%. But we know that the market doesn't return 9% every year. It can go down as much as 40%, which it did in 2006. We know that it can go up by double digits, which it does many times. But all of those ups and downs work out to be an average annualized rate of return of around 9% before taxes. Just like people put money into the stock market, you need to go into this with the expectation that regardless of all the ups and downs, and there won't be downs in a life insurance product because it's principal protected. So in that regard, it's a lot safer than more traditional investments. But you just have to go into it trusting that you'll realize the annualized rate of return over some long period of time. All right, the second mistake is a little bit more significant. Whenever people realize that they can earn, say, 6% and borrow at 4%, they start getting the crazy idea to finance the premium using policy loans against the policy. After all, if you could just borrow against the policy, maybe kick in a few extra dollars, you could finance the future premiums of the policy without ever having to put in anything more than just really that first year premium. And while this looks good or sounds good in theory, in reality, those returns can be, again, between 0 and say 12% each year, with the average around 6%. So that's not a guarantee. And when you're financing the premium and the cash value doesn't go up, but yet your loan balance requires interest, you might have a problem. That policy could lapse. So this is not a strategy that I recommend. And I think most people go into this not fully understanding that loan is not your money. That loan is the insurance company's money, and it has to be netted out against your returns. So if we look at this graph, all the policy owner is really capturing is just that tiny little sliver between what the cash value is earning and what the loan balance or payoff is. So everybody sees the growth of the cash value over time, but they forget that that's netted out by the loan balance, which is being financed. So every time the interest is due at the end of the year, the insurance company is loaning the policy owner the money to basically pay themselves the interest. So every dollar of gain in the policy is basically set off by a dollar of interest that's owed on the loan, or maybe 80 cents of interest. So all the policy owners is really capturing over time is just that narrow sliver of wealth or equity that's created between the cash value and the compounding loan balance. All right, so let's assume I was talking about you. You had the crazy idea that you would put one premium into a policy and then borrow against it to pay the subsequent premiums and just keep borrowing against the policy to keep it going. Here's a better way to do it. Just pay the interest. Budget enough money to pay the interest on the loan. So if you had $250,000 of savings and you wanted to get that into a life insurance policy, you might design a policy around $50,000 a year of premium payments. Now, the reason for the 5-year funding is discussed in an ebook that I've got available on my website in the store called Don't Make This Policy Design Mistake, which goes into the reasons why you don't want to put a lump sum premium into a life insurance policy. So if you're interested, go out to the store and grab that for $5.99. For the price of a beer, you can learn a trick that will save you thousands of dollars when you do your policy. But what I'm going to show you here is a more sophisticated way of going about it, where you actually can get a lump sum of money into a policy and do it efficiently. It's just that you're taking on more risk by financing the premium. But I'm going to show you how to do it right instead of doing it the wrong way. So let's take a look at this table. Assuming the same $250,000 of lump sum savings, I'm just showing a very conservative way of getting that into a life insurance policy. So this table is based on a 45-year-old who's going to put $150,000 of premium into a policy each year for 5 years. With this particular design, the policy owner is coming up with the original $150,000 for the first premium payment. And then each year they're going to borrow against the policy's cash value and then kick in a little extra cash from out of pocket to come up with the amount that they need to make the next $150,000 payment. So if we start in the upper left corner, we've got the first year of the policy, the client's age is 45, premium is $150,000. There's no loan the first year. So they're coming basically out of pocket for $150,000 that year for the premium. On that $150,000, the beginning of year cash value is $130,000, $130,398 to be specific. Since there's no money being borrowed the first year, there's no annual interest, no cumulative interest, and after the interest crediting is paid at the end of the year, there will be $137,531 of cash value. And I think this is assuming a 5.47% growth rate on the cash value. So year two, the client is now 46 years old and needs to come up with another $150,000 premium. So how are we going to do that? Well, the client is going to borrow $123,878, and mind you, that's not equal to the cash value from the previous year, but I put in, I think, about a 5% fudge factor just to leave a little bit of buffer behind for safety. So client is taking a $123,878 loan, and they need to kick in from out of pocket another $26,122 to come up with the $150,000 that they need to make the premium payment. So now, cash value at the beginning of the year is $266,580. And if we go across to the last column, we see the cash value net of loans, and that's $157,000. Again, just being conservative and reducing that amount. The next year, client is going to borrow against that new equity in the policy, borrow $135,566. They'll have to kick in an extra $14,434 from out of pocket. And now the cash value at the beginning of the year is going to be $408,000. So basically this cycle repeats itself for 5 years. And you can see that after the 5th year, the client no longer needs to come up with cash from out of pocket. So at this point in time, they could actually, if they can afford the interest, continue to borrow against the new cash value to put more premium into the policy. But the determining factor in how long you can do this is in the annual interest column. After the 5th year, the client is paying $22,001 per year of interest. And I don't know what the rate was on this example, but keep in mind, the interest rates on these loans are going to change. But you can see that the interest expense is fairly level throughout. So the only thing that's going to change is just how much you have to spend on it each year. And it's only going to vary, just a few points one way or the other. But what I really want to direct your attention to is look at the cash value net of loans column. So between that and the end of year cash value, you can see that the cash value is growing at a compounding rate. So while your expenses are staying level every year, the cash value is growing at a compounding rate. So you're creating this huge spread between the loan balance, which you can see at $550,023, the cost of which is $22,001. But with every passing year, the loan balance stays the same, but the cash value is compounding. So we see that the cash value net of loans keeps going up and up and up and up and up. So this is the way to do it. So let's take a look at another graph showing this. And here, the number of years that I have in this graph makes it look a little unrealistic, but that's just the power of compounding interest and time. But if we look at this on a reasonable perspective, like from 45 to say 65, you can see the delta created between the end of your cash value and the interest. So this is a very attractive model, because as long as you can afford the interest, that expense stays constant over time, but you create more wealth with every passing year. So the longer you can keep this up, the better. I mean, if it were up to me, I would pay that interest every single year and never pay it off. But ultimately, because it is a life insurance policy and you don't have to pay back a life insurance policy loan, you at some point in time, like when you retire, you can simply stop making the interest payments on that loan. And now what you're going to do is simply borrow the interest to finance the interest on the loan, and you keep on doing that every year. So again, even if the interest rates were equal, this could continue on forever, right? So if your loan rate was 5%, if you borrowed $100,000 at 5%, you would owe $5,000 at the end of the year. But if the cash value is growing at 5%, that same $100,000 that's securing that loan grew from $100,000 to $105,000. So the $5,000 that the insurance company is loaning you is secured by the growth on the policy. So those two things stay in sync with each other. And the same thing is true here. At some point in the future, when you no longer want to make payments on that loan, you simply stop making the interest payments. And when you do that, the insurance company doesn't see you sending in a check, so they simply finance the interest. But at that point in time, you can basically kick back and enjoy that wealth that you created in there and use it to generate tax-free retirement income for yourself. So that is the beauty of premium financing, and this is a much better way to take advantage of arbitrage than trying to do it the way that I had mentioned it earlier, and the way that I can't tell you how many people come to me with that idea of leveraging the premiums like that. So I just thought I'd make a video to kind of address that one issue, and I'll use this video to direct those people to in the future to explain why they don't want to do that. All right, so concluding, the proper interest rate arbitrage is on the outside of the policy. You are borrowing money to make investments. You can borrow whether the cash value earns interest or not. It doesn't matter whether your cash value is earning 0 or 12%. It's all about the wealth that you're creating on the outside of the policy. So with that, I'm done. If you want to learn more without talking to a life insurance agent, I highly recommend that you go out to Facebook and join the Double Play group, where you can network with my clients, prospective clients, and just people who have found these YouTube videos and my mention of the group, and just network with people who are using this strategy, who are thinking about the strategy, bounce your questions off of them. I'd really like to see the dialogue, continue on in that forum, and take advantage of people who are actually doing this, as opposed to listening to me, who's obviously a biased agent. In addition, I've got tons of other videos on this YouTube channel, and my website is what I consider to be a no fluff zone. So there's tons of information freely available on there. Go there, enjoy it, read everything you can. Almost everything that you can possibly want to know can be found there, short of seeing an actual illustration. So be sure to like this video, subscribe to this channel so that you're notified whenever I come out with new videos, and I will see you in about a month when I come out with the next video. Thanks for sticking around.